Welcome back in YouTube. So in this video, we're going to go over a lot of things. I'm going to try to move as fast as possible. Hopefully you guys enjoy and find tremendous value in this. Now, if you're new to the channel, welcome into Compounding Capital, where we focus on long-term price action and fundamentals. Now, in this market, it is definitely getting stretched, but we found tremendous value. Yes, a little more higher risk, higher reward. And of course, I always just recommend dollar cost averaging into a broadly diversified index. Set it, forget it. This is not financial advice. This is just my personal journey and just my opinions. So let's get into what is going on in the markets and where I see opportunities and or traps. First thing I want to point out is the VIX is now breaking out, up nearly 12%. I think we're going to start seeing the market roll over here. When I look at the technicals, we're a little bit overbought, definitely due for about a 5 to 6% pullback, could be greater than that. But I want you guys to stay focused on some of the more deep value opportunities that I think the market's presenting. Now, when we look at the S&P down 1.2%, the Dow is actually separating itself. This is a separation we've talked about of more of your deep value type stocks and quality type stocks that are trading for reasonable valuations. And the Dow does have a few names like that. And so that's why I think we're seeing the separation. We're seeing the NASDAQ sell off. A big part of that is going to be the chips, with NVIDIA leading the sell off down over 7% on the day. Russell is giving some gains back from yesterday, down right around 1%, and obviously we're seeing that break out in the VIX. Now, with all of that taking place, my account is hitting newer highs. We are up nearly 1% on the day. We were up over 2% yesterday. And so as the market's selling off, we are running a contrarian portfolio, which is probably going to do mainly the opposite of what the market's doing. While things are trading for 25, 30 times earnings, we're looking for those 10, 11 times earnings with deep value assets underneath the underlying equity that can really give you high returns, higher risk, high reward type names. Just to go through a quick rundown here, you guys can see that Pfizer is my largest position, bought it around $25. That's where my analysis told me to start looking at the company. With the risk coming in that Pfizer could have gone into the high teens. A lot of good news coming out with Pfizer, and I thought this was a deep value asset here, especially with the acquisition of Seagen. When you're buying Pfizer, you got a $68 billion asset nearly for free here. Cisco Systems, we're going to dive into this one. I'm very, very excited to compare Cisco Systems to what I think is an opportunity that Microsoft had back in the day. Warner Brothers Discovery, guys, we bought this around $7 a share. Very high risk, high reward, but the assets were saying that it was worth more than what it was selling for. And that's where our analysis brought us to buy Warner Brothers Discovery. Zoom Video, we reached on just a little bit here, bought it around 56 and change. Currently, the stock is at $58. And then Bumble, we bought right around $9 a share, and it's at $9.44. Would like to add into Zoom on a big pullback and Bumble in the $8 range. So that's just a quick run through of kind of where my portfolio is. Now, a position I would like to add into is Amazon on a big dip. If we're getting a market rolling over here, I have some cash that's ready to be deployed, and Amazon would probably be one of my largest holdings. But in this video, I want to talk more macro here. Now, with interest rates coming down, naturally, we're seeing a pop in REITs, and we're seeing a pop in companies that rely on debt markets, which is going to be more of your smaller cap companies and companies that are probably not profitable currently. So we're starting to see that broadening of the rally due to interest rates coming down and valuations starting to kind of getting compelling here for more of your deep value names that I've kind of bought recently. So when we look at this, on the surface, there is definitely a technical breakout taking place with some of your REITs. They've been underperformers and they're breaking out a pretty significant downtrend. Now, the thing I really want to bring to your attention is Vici and Realty Income are two names that we do talk a lot about on this channel. They're popular stocks. And when I look at these two companies, I'm concerned a little bit more longer term with Realty Income here for a few reasons. Number one, we're still at a higher interest rate market than we've seen over the last 14, 15 years. And there is a big refinancing debt cycle coming by the end of this year and into 2026. So over the next 2.5 years, Realty Income has a substantial amount of debt that they have to refinance. That is not my biggest issue, believe it or not. Well, my biggest issue is when we think about how they're diversified, it really comes down to big box retailers, companies like Walgreens, CVS. And what are we noticing with those types of companies? They're closing down stores, and now we shop mainly online where things get dropped to our doorstep nearly same day. When we take a look at what happened with Five Below, down 22%, still big problems with retail. And where do we see the exposure in Realty Income is in the retail sector. So it has two big headwinds that I think are going to be here for a little while. Number one, higher interest rates, which means less free cash flow. And number two, retailers closing down shops, and a big part of their portfolio is based on retailers. So I look at this and I say, realty income, I understand it. And I can make a compelling story that between $50 to $55, there might be a bull case there. The problem is I don't think the headwinds are quite over for this company. I actually think they're just starting to formulate and things are just starting to come to a head. Now we have a market possibly rolling over. We have retailers closing stores. There's some dynamics here playing out. While it's having a technical breakout, I don't know if it's going to be long-lived. Yes, it could last for 6-7 months, but I think when we get into this refinancing cycle, we could actually see a significant dip once again on realty income. Of course, this is just my opinion, and as I stated, I can definitely get behind a bull case for realty income in that $50 to $55 range. So let me talk some deep value here and why I think Cisco Systems is very, very uniquely positioned. Now, I don't know a lot of companies that really cover Cisco Systems, and I don't think many people are as bullish as I am, especially if you can get in that $44 to $45 range. I think the downside risk could be in the mid 30s, so you do have a 20 to 25% downside risk. I think the upside actually outweighs the downside in this company, especially when you factor in nearly a 3.5% dividend. Now, Google is making its biggest acquisition ever. I want you guys to think about this really quick. Google has made its biggest acquisition ever. This should be actually pretty big news, and it's really not being talked about. What does Google have to do with Cisco Systems? Well, Google acquired a company called Wiz for $23 billion. Now, Wiz is the fastest growing software company ever, and I can understand paying a premium for this. Now, here's where I think Cisco gets a little bit more interesting. We just watched Google buy a company that's doing over $100 million in revenue at this point in time. That's annualized reoccurring revenue over the last 18 months. And they paid $23 billion for that. Okay, so obviously there are some synergies there. They're obviously seeing a huge opportunity. Why does this what does this have to do with Cisco? Cisco Systems usually has hardware, but they made the acquisition of Splunk for $28 billion, $5 billion more than what Google paid. What is the big deal with this? They bought a company doing over $4 billion in revenue versus a company that's doing $100 million in annualized recurring revenue. So yes, while it's one of the fastest growing companies that Google has purchased, as those numbers get larger and larger and larger, the speed at which that company is getting that annualized reoccurring revenue is probably going to slow down, especially when it starts hitting the $1 billion mark. The competition is going to pick up, and it's already getting competitive. And by the time this deal closes, who really knows who's going to be the winner and loser of this? But Cisco acquired a company for $5 billion more that is doing 40 times the revenue. Now, I was definitely extremely bullish on Cisco Systems below $45 a share. Now it's trading around $48 a share. I'm up slightly on it, and with dividends reinvested, I'm looking at a closer to a 6-7% gain here. But while most of the industry is trading for 25-30 times earnings, we're looking at Cisco Systems trading at a forward PE 13 times earnings. And this is not what I'm excited about. Price discovery, I think, will eventually happen for Cisco. I think they're positioned extremely well, and it's definitely overlooked by the market. This company probably should be closer to 15-16 times forward earnings. And here's the reason why. Everybody is buying chip makers because there's going to be a massive AI demand. But if we're building all these computers, we're building all these robots, majority of this hardware is going to be coming from Cisco Systems most likely. We're talking about routers, we're talking about cords, adapters. All those types of things are in Cisco's wheelhouse. And when you're buying Cisco Systems, the stock has been dead money for about 10-15 years, much like Microsoft was back in 2001 to roughly 2015. It was between a $20 to $30 stock. It wasn't a high flyer until it made great investments. And I see this Splunk deal as a great investment. And I also see a massive tailwind as far as their hardware business goes. So I think there's two big tailwinds for Cisco that the market is completely discounting here. Now, of course, I could absolutely be wrong. Someone else could be the winner here. Cisco could manage to mess this thing up, but it seems like they're positioned extremely well, and nobody's really interested in the stock. Much like nobody was really interested in Pfizer paying over a 6% dividend, trading at $25 a share. Now it's knocking on the door of $30 a share and may even have a pill that can compete with the weight loss drug rather than injections. So when these companies go on sale and get overlooked, that tends to be where I put my focus. When we start looking at companies that are trading at 25, 30 times earnings, most likely perfection is priced in and retail is already late to the story. I think we can look at Nvidia as a great example of this. Nvidia was positioned extremely well, had some decent fundamentals, and the valuation was pretty good. Where did everybody miss the opportunity? Was that a gaming company? Could actually be an AI company. Very similar to the Cisco setup, but Cisco has pretty strong fundamentals. So even if they bobble this, I still think you're buying a decent company at a reasonable price. I'm not as excited about it if they mess this up, but if they can execute the way I think they can, I think we're looking at a very undervalued asset here that could be trading closer to 20 times earnings over the next few years, which means that it's probably undervalued by like 40%, reinvested that 3.5% dividend. We could be looking at closer to a 50% rate of return, in my opinion, on a company like Cisco. So hopefully you guys enjoyed, and if you're subscribed to the channel and hit that bell, we are doing a live stream. Try to do it once a week and creating a watch list of companies that are tremendously undervalued, much like the ones that I've mentioned, but maybe you can get there before the market does. As always, guys, appreciate your time. Thank you so much for spending it with me, and we will see you in the next one.